Today, we're diving into a topic that's essential for anyone in their 20s or 30s: investing. If you're looking to build wealth and secure your financial future, this episode is just for you.
Welcome to Personal Finance Cat, where I share my personal take on personal finance.
First off, let's talk about why investing is so important for millennials. Many of us are still navigating through student loans, rising living costs, and an unpredictable job market. However, starting to invest in your 20s and 30s can provide significant advantages, especially with compound interest on your side. So, where should you start? Here are some key points to consider. 1. Understand the basics of investing. Before jumping in, it's vital to understand some basic terms. Investing typically involves putting your money into assets like stocks, bonds, or real estate, with the hope that these assets will increase in value over time. Familiarize yourself with concepts like risk tolerance, diversification, and asset allocation. Now, I know that some people are turned off by investing because it could sound very intimidating, and I've been through that journey as well. Fortunately, nowadays there are so many resources out there. You can listen to YouTube videos, listen to podcasts, and find the one that you really like, the style that you really gravitate towards. It took me a long time to get into investing in individual stocks. I think what really ticked with me was reading some books about how Warren Buffett invests. Now, I've since really branched into other areas of investing, and I found there are so many techniques that you can utilize. But you can start with something that is simple and you can understand, and then gradually go from there. And trust me, it's very rewarding and it's very interesting. 2, set clear financial goals. What do you want to achieve with your investments? Are you saving for a first home, retirement, or perhaps a big trip? Setting clear, achievable goals will guide your investment decisions. Short-term goals may require more conservative investments, while long-term goals can leverage riskier options with higher potential returns. So this is where people who are still in their 20s and 30s have an advantage, because you can have short-term goals, but you can also have the time to invest in riskier options because you have time to recover, even if it goes the other direction. So here I want to recommend that you separate the two investments into different accounts so you can manage the conservative position versus the riskier position. But I would say, generally speaking, you can probably afford riskier options. By that, I mean you can invest in stocks and even other alternative assets like cryptocurrency, as opposed to just the bonds or CDs, which are really not good options because the returns sometimes can't even cover inflation. Again, do your research and find what's comfortable for you. 3, start early, no matter how small. Again, like I said, one of the most significant advantages millennials have is time. Even if you can only start with a small amount, like $50 a month, it will grow over the years. Open a brokerage account or a retirement account, like an IRA, and automate your contributions. It's often said the best time to plant a tree was 20 years ago. The second best time is now. Of course, when you're younger, your income is also less, but time is really the compounder you need. If you haven't checked out my other episode about opening up an IRA account for your child, feel free to listen to that one as well, because it shows just how much time can help you grow your investments. Even very nominal investment at the start, compounding it over a long period of time will really give you a huge reward at the end. Yes, right now you're already in your 20s and 30s, but it's not too late because you still have 30 years plus to wait until you retire and need that money. This amount of time really adds up your return. Even a very small contribution a month can really add up. I mean, $50 is really nothing nowadays by skipping going out one time per month. You have that $50 right there. But if you pick the investment wisely, and especially the riskier option where you can really secure a high return, compound it over many, many years, it will be a huge reward. Even 100x is not out of the question if you know what you're doing. 4, educate yourself on investment options. Now let's explore some investment vehicles. A, stocks, which are great for long-term growth. Buying shares means you own a piece of a company. And if you invest in those high quality companies that are just great compounders in terms of return on investment, then over the long term, they will handsomely reward you. B, bonds. Considered safer than stocks, they provide fixed interest over time. So again, going back to separating your investments into the safer option versus riskier option, bonds would be good to add to your safer bucket. C, mutual funds and ETFs. A good way to diversify without having to pick individual stocks. These mutual funds and ETFs basically pool money from multiple investors to purchase a diversified range of assets. A very commonly used mutual fund, technically an index fund, is S&P 500. And over time, it averages about 8% return annually, which is not bad. It probably outperforms a lot of actively managed funds, and it's very cheap to buy. D, real estate. If you're interested in properties, consider how real estate can fit into your investment strategy. I invest in real estate, and I got lucky because I invested during the downturn after 2008. But now real estate is getting really hot, so I'm diversifying away from real estate and more into stocks currently. 5, keep an eye on fees. Investing isn't free. Be mindful of investment fees, which can eat into your returns over time. Look for low-cost index funds. As I mentioned before, S&P 500 is a very good option. There's also total market index funds. Instead of tracking the 500 top companies, it tracks the total markets. It could be the US markets or US plus international markets. If you choose these options, you can minimize your expenses. Research platforms that align with your financial goals and fee structure. 6, stay informed and adjust your strategy. The financial landscape is always changing. Stay informed about market trends and economic news. Your investment strategy should evolve with changes in your life circumstances and financial goals. Don't hesitate to reassess your portfolio at least once a year. Nowadays, there are just so many resources out there. Like I said, I started with value investing and it really made a lot of sense to me. But then after just hearing people talking about different strategies, I got interested in other types of investing styles as well. It's not that I completely follow one style nowadays. I combine value investing principles with some technical analysis, and I find that that makes me comfortable making certain moves that I probably wouldn't have made a couple of years ago when I was only focused on value investing. Depending on your aptitude and risk tolerance, there are many things you can explore. But what's important is to stay educated, stay informed, and adjust your strategy accordingly. 7, avoid emotional decisions. It's easy to let emotions guide your investment decisions, especially during market downturns. Remember, investing is a long game. Stick to your plan and don't panic during temporary market volatility. Even though I've dabbled into different investing styles now, I would still say that I'm a long-term investor, which is what will give you peace of mind, I believe, because markets are just so volatile during the short term, especially with changes in politics, technology breakthroughs, whatever have you. It's always moving around for factors beyond fundamentals or how the companies are actually doing. So sometimes there are a lot of significant short-term volatility, but if you have a long-term mindset, that's going to help you a lot to stay sane and stay emotionally balanced. To wrap up, investing in your 20s and 30s can set you on a path to financial freedom. Start by understanding the basics, setting clear goals, and being consistent with your contributions. Keep educating yourself, stick to your strategy, and watch your wealth grow over time. Thanks for listening to this episode. If you enjoyed it, please don't forget to subscribe, rate, and review. Until next time.